Our guest prefers owning companies focused on natural gas. He cites increasing energy demand for AI data centers and a possible further weakness in oil prices. We're joined by Daryl McCoubrey, Vice President and Senior Analyst at Veritas. Great to see you as ever, Daryl. Thanks very much for joining us.
Good afternoon, and thanks for having me, Andrew.
Start off just with this theme, though, of possible more mergers in the oil patch. We have seen a bunch of takeovers, as we have in gold, of course. Do you think that's going to be a factor in the market this year among Canadian energy companies, M&A?
I think if the kind of widespread concern concerning like quarterly consistent supply build or stock build in global liquids markets, if that plays out and the feared kind of trajectory down towards a $50 per barrel WTI kind of environment, I think then you could see some urgency perhaps amongst some players. But on the whole, I still think the real focus here is shareholder returns still. And there's an apprehension, I think, to use the balance sheet to supplement shareholder returns. So I might fear that the reception of an M&A, an aggressive M&A policy, could be looked down upon, even if it's mostly debt funded, meaning the cost of capital is relatively low.
Right. Shareholders might think, well, okay, you've got a nice big company, maybe you get a bigger paycheck for more overseeing more production, but what's in it for me?
That's exactly it. I mean, the sentiment is pretty clear that direct returns through the base dividend, special dividends, and buybacks is what's appealing to the energy investors currently.
What right now, and we're looking at some of the points, you do say that there's a cloud over the anticipated stockpile build in oil, and you're less enthusiastic about liquids. Gas generally is meeting your needs right now, partly because of the anticipated electricity growth?
Yeah, I mean, broadly, globally, transition is kind of defined, the decarbonization by electrification, mostly premised upon wind and solar, winning a lot of market share within electricity markets. AI is just one component of that. There's the EV theme as well. There's potential displacement of kind of direct distributed natural gas with electric heaters. But foundationally, I think the idea is that if it's going to be an electrification theme, there's a bit of a kind of high watermark maybe on some of the resource constrained technologies like solar and wind, to the extent that once they get to maybe a quarter of a grid supply, they're going to be bumping up against the reserve margin of those grids or the available capacity in the event that the resource constrained tech isn't available to produce. And so I think that's why you're seeing more of a focus on baseload in general. And then, of course, the kind of 24/7 secure data or power needs of data centers, that also supports more baseload energy. And so the competition really isn't between like wind and solar versus natural gas. The competition is more in the capacity resource market, where natural gas will compete against nuclear. Natural gas might compete against utility scale batteries. And in those arenas, natural gas holds a pretty significant cost advantage currently. And so if electrification is the way and affordability is still a core concern globally, natural gas is an appealing bridge fuel. And so I'd say my preference for gas stocks over liquids isn't so much just AI specifically. It's the cost advantage of natural gas as a bridge fuel to potentially displace solid fuels like coal and liquid fuels like fuel oil that we still use quite a bit of in some regions of North America still.
Just getting onto stocks that you favor right now, Imperial Oil's had an incredible run. I mean, despite a relatively weak oil price, these oil sands giants have thrived. You have a sell on Imperial right now.
Yeah, so there's a couple elements I think at play there. The market, I think, is already looking forward to a worst case where you could see benchmark WTI trend towards US 50 per barrel. In those scenarios, Imperial holds up relatively well. We were assuming a base case price of about US 60, so just a shade below where it is today. So that's one element. The other is, of course, the Exxon ownership, the very low cost of debt, even though they don't use a lot of debt. Having that low cost of debt theoretically should keep their cost of equity pretty low. And also, of course, the risk premiums should be lower because of their integration that provides the defense at lower WTI prices. And so all of those elements, I think, have caused a bid up on valuation for Imperial.
Major's a little expensive for your taste.
Well, I think of Imperial as kind of already being owned by maybe the best special interest purchaser it could possibly be owned by. And so that's not necessarily a negative thing, but it is something to contemplate when comparing relative value against competitors who don't currently have that advantage, because maybe one day a special purpose purchaser comes in and takes out the likes of some of the other oil sands players that don't have an Exxon at their back yet. And maybe they could unlock synergies across the cash flow statement elements.
Thank you very much, Daryl. We better leave it there. Great hearing from you. Daryl McCoubrey, VP and Senior Analyst at Veritas Investment Research.